So at some point I knew that this was going to turn into this if I just did nothing with my money. So that's when I got into investing. And maybe you've decided to start investing as well, but have no idea where to start. Well, great, because you've stumbled across this video and I'm going to tell you exactly how to start investing in Australia as a complete beginner. But don't worry, because I used to be like you too and had no idea what investing even was when I was young. So as I explored all the investing opportunities and made plenty of mistakes along the way, all that experience that I've now gathered, I'm going to share with you here and teach you exactly how to start investing in Australia. So first, the reason why investing is necessary is because of something called inflation. And that is a decrease in the value of your money every year at a rate of around 2 to 3% in Australia. So to combat this, we have the first investing method, which is to put your money in a high interest savings account. This is the easiest and most risk-free way to make money with your money. And the bank will just pay you interest monthly as a percentage of how much you keep in your account. Now this is a variable amount which is tied to the RBA's cash rate. So 30 years ago it was around 17%, but 10 years ago it was around 7%, and now it's practically zero. So that's likely to stay there for a long time to come as well. If you're lucky, you might be able to find a bank that offers an interest rate of around 1% by smaller banks such as ING or any of the online neobanks that are trying to win over customers away from the big four, who usually offer really lousy interest rates. So definitely try and shop around. Signing up to a bank is as easy as applying directly on their website and then just transfer all your money in. But keeping money in the bank is hardly investing at all, and it doesn't even make enough to keep inflation at bay. So another investment type is in commodities. This is lots of different types of precious metals and even oil, but the most well-known commodity is investing in gold. So in the last 50 years, gold has appreciated in value by an average of just under 10% every year. So this means that if you invest in gold over a long term, you should expect to beat inflation by around 7% annually. There's a few ways to invest in gold. The first is obviously to go and buy physical gold, but then you need to deal with the markups by the seller and then also deal with the secure storage of it. So it's not something that you should consider. Instead, the best way to invest in gold is to actually buy gold ETFs listed on the stock market. The ETFs themselves will invest in gold bullions and you invest in them. So that way the physical gold doesn't actually move, even if its ownership might have changed several times. So some examples of gold ETFs include the ASX stock ticker GOLD, G-O-L-D, and even Perth's Mint's PM Gold. Now to buy gold ETFs, you'll need to use a stockbroker, but I'll explain more about that when we get to the stock market section. Just be aware though that even though gold is a very stable investment, which means that it won't crash during a pandemic, but also won't go up very high very fast either. So the low risk will only give low returns, and the opportunity cost of keeping your money tied up in gold could be much higher than that. So now let's talk stock market. In Australia it's called the ASX, and it's a great place to start investing, especially when you're young. Whether you have $100 or even $100,000, it's accessible to everyone aged 18 and over. But the thing that stops most people from investing on the ASX is trying to choose the right one from the thousands of publicly listed companies. Well, as a brand new investor, I always recommend simply just buying an index or an ETF instead. For example, a top 200 index on ASX has the ticker XJO, and buying this means that you buy a little bit of everything in the top 200 companies on the ASX. If you do that, then you get instant diversification on your portfolio as well as the market returns of the stock market. There's a full list of indices on the ASX website that I will leave down in the comments below. Now, the problem with the ASX index is that it only reflects the overall stock price, and a better way to invest is to buy an index fund that's offered by a third-party company such as Vanguard. For example, if we look at the ticker VAS, it also closely tracks the top 300 stocks on the stock market, but it also pays a dividend of all those stocks as well, which is roughly around 3.1% in dividends. But then if we deduct the management fees of 0.1%, then our net dividends will be around 3% plus whatever the share price will increase to. I think if you've never invested before in your life, then an index fund is exactly the first thing that you should consider investing in. This is the easiest way to invest your money in Australia, period. And historically has returned around 12% every year. That's not even including dividends yet. Now, that might not sound like much, but if you invested just say $200 in an index fund every month for the next 30 years, you'll end up with $700,000, with most of that not coming from your monthly deposits, but from the interest itself. Your regular deposits only made up $72,000. You can play around yourself with the compound interest calculator on the government's Money Smart website and see the magic of compound interest at work. Now, index funds are great, but it limits your portfolio to Australian shares only, which might all be effective if Australia suddenly gets into an economic slump. This is why an ETF might be a better option, because it's similar to an index fund, but its fund managers can pick and choose the companies to invest in. And they're not limited to Australian stocks either. They can choose to invest part of the fund into US stocks like Amazon and Facebook or Google, and give you even bigger diversity on your investments. Now, there's a whole range of ETFs that you can choose from, and they all hold different types of stock to try and get the best returns for you. So my personal favorite is an ETF called VDHG, or Vanguard High Growth, which is an ETF that invests in other ETFs, which means that you get the best of a whole range of funds purely from investing in this one fund. Sure, the management fees are slightly higher at 0.27% compared to just 0.1% for an index fund, but it's very minimal considering how much money it's going to make you in return. Now, the third type of investment that you could make on the ASX is what's called a LIC, or a listed investment company. So this is a publicly listed company with fund managers that actively seek to trade stocks in other public companies that they think will beat the market on your behalf. So in other words, you'll be hiring professionals to try and get you a higher return. Now, this does come at a higher cost though. Its management fees are around 1%, and the company also get a cut of the profits if they do outperform the market. So what's better, a LIC or an ETF? Well, I think a LIC can give you slightly bigger returns, but the management fees will eat into those gains, which kind of makes them even out. And remember, those higher fees have to be paid even if the fund doesn't outperform the market. So for that reason, I personally have headed into the ETF direction. So to buy anything on the stock market, you'll need to have a stockbroker platform that I've summarized in another video there or there. Once you've signed up, it's as easy as heading to their buy page, type in the stock ticker, quantity, price, and then hit buy, and you're done. Now, the next investment type that I have to mention, even though I don't really call it investing, is the cryptocurrency market. The biggest of which is Bitcoin. Now, the reason I don't call it investing is because it's a pure speculation game. Unlike the stock market, where the fundamentals of company value and revenue and the stock price to earnings ratios are all very well established and have a correlation to the actual price of a stock. But Bitcoin, on the other hand, or any other currency, has none of that. And buying it at any price is just how much someone else thinks the price should be at any time. And that price could be as high as $100,000 on one day and then less than $5,000 on another day. That kind of volatile movement is definitely not a long-term investment that you can bank on, and it's definitely more like a lottery than an actual stock market. So if you're still interested in that kind of thing, only put money that you can afford to lose. Buying into cryptocurrency is actually pretty easy. Just log on to an Australian-based exchange such as SwiftX, CoinSpot, or Binance Australia and deposit funds to trade for Bitcoin or any of the ETH-based altcoins, and you're in that ecosystem. Again, I stress that this is a highly speculative and volatile guessing game that is just not a traditional type of investment that regular investors will be into. So now we get to the final investment type, and it's the big one because it needs the most amount of capital just to get started. And that, of course, is in real estate. But just like the stock market, there are also different types of real estate that will perform differently independent of each other. We saw this in the pandemic where houses in more regional areas were outperforming apartments in large, denser areas. Now, retail property and offices in the CBD took a massive hit to its tenancy rates and by extension its value as well. But commercial property and industrial property were pretty much unaffected. But depending on when you're watching, that might all flip the other way around sometime. So if you want to invest in any kind of property at all, make sure that you not only have the 20% deposit for the property itself, but also some backup funds to deal with the landlord responsibilities as well. As for returns, residential property will earn around 2 to 4% in rent when you first buy it, and then gain around 8 to 10% in capital gains on average. So worst case scenario, that's around a total of 10% gain, which is a bit lower than the stock market. But it has the advantage of leveraging your money to create gains from your debt. And that's probably a topic for another time, but long story short, it's basically just borrowing the bank's money at a lower interest rate to rent out the real estate that you bought with at a higher yield rate, and then you just pocket the difference. You can then wait some time for the property to appreciate in value, refinance, and then buy another property. And then do this over and over again until it can generate enough money for you to quit your day job. That, of course, is the dream for everyone, but it takes a long time and usually needs some sort of a leg up in the first place. And this is where the stock market is an excellent accelerator for that leg up, and one that I highly recommend to start on first. Even if you're not ready for the stock market, there are plenty of stock market simulators that you can go and try out with fake money to see how well you would have done just to improve your confidence for when you decide to start. So I hope that makes things a little bit clearer for you and helps you take your first step towards investing as a complete beginner in Australia. I'll make a video on the best index funds and ETFs to start with, so make sure you subscribe to the channel so you don't miss out on any of those videos. And also hit the like button for me as well, so YouTube knows to show this to other new beginners as well. Thanks for watching, guys, and as always, I'll see you next time.